Hello, everybody. This is Joe Gordon with Gordon Asset Management. Today is June the 16th, Tuesday, and this is our weekly update on all things going on with the market in this very strange stay-at-home economy that's trying to open up. As usual, we have, excuse me here, a little haste. We have our disclosures that we're not giving tax or investment information. This is merely our opinions based on what we're seeing out there in the financial and other news press about what's going on and trying in an attempt to bring it to you in a condensed matter that makes sense from an investment and asset allocation and market perspective. Okay, so you can always sign up on wealthqb.com. You can follow us on YouTube. The way you do YouTube, you just go to youtube.com and you just enter and search our company name, and up will pop the channel and all of the series of these calls you can listen to at your own convenience. Most of these calls now we've reduced from an original or a maiden voyage of 50 minutes and about 50 slides to about 25 slides and doing it in 20 minutes or less, so the busy people can get what they want immediately. So let's go quickly to coronavirus news. There is some good news out there all over the place. Here was one interesting bullet about generic steroid drug. I'm not going to attempt to pronounce it, to patients admitted to the hospital, gave significantly reduced death rates by about a third of those with the most severe cases. And this was a major breakthrough led by a UK clinical trial. So there's others going on. There's really too many to put in slides. It would bore you, and I can't pronounce these words anyway. Stimulus news. There's an infrastructure bill now in the news pending. It's got bipartisan agreement of doing it, but just not bipartisan agreement on how to do it. And of course, that's not atypical in the political environment that we're in. Builder sentiment has jumped a great deal, over 50% in June, the largest one-month increase ever. Makes sense. Interest rates are at the lowest. I refied my mortgage below 3% and closed in May, and obviously I moved a month too soon. But clearly, zero-bound interest rates are encouraging many people to refi and also people to look for homes. One thing that's interesting about buyer traffic doubling, the last bullet down here, is that many people that have previously been living in condos and apartments where you share common space with others decided maybe that's not the safest thing to do. Maybe we should get our own home. So let's look at the prior week's Small Business Pulse survey. This is concerning. So you can see here, census small business owners published by the census. 50% have said they experienced a decline in operating revenues in the past week. Only 17% saw an increase. 25% of small businesses were closed for at least a day that week, even with all the reopenings. A little bit less than 10% lifted employment, a little less than 12% boosted hours worked. 36% continue to experience supply chain disruption, and many of small businesses, as we all know from PPP, Paycheck Protection Program, are on life support, 71+%. So clearly, many are concerned what happens to small business and the economy and the stock market indirectly when these funds in PPP dry up. And there has been continued legislation issued on how to apply to repay and possibly get a grant for small businesses that got less than I'm having a little problem here with my slides. For small businesses, there is talk out there that there's going to be grants for loans of less than $150,000. Other news: Jerome Powell, Fed chairman, spoke last week at length, and the basically trying to reassure folks about a lot of things. He did notice that, hey, small business is almost half of the labor market and 44% of GDP, and they are being imperiled by the slow move back from the recession that began in February. And he says they're not even talking about raising interest rates anytime soon, and he's testifying before the Senate as we speak. So now let's look at other sentiment. 3 in 4 money managers believe the market's overpriced, the most since Bank of America started this survey in 1998. More than half say the comeback from the March lows is a bear market rally. That's the consensus belief. Only 37% say it's a new bull market. Well, one of the good things about this bullet is that because only 37% think it's a new bull market, maybe that's a good thing, because if 67% believed it's a new bull market, there'd probably be a lot more fluff going on, and that valuations would even get more stretched. And the euphoria led to investor cash levels dropping in June from May, biggest monthly drop since back in August of 2009. That is interesting too. I saw a data point yesterday that retail investors have over $4.6 trillion in money market funds. Private equity has somewhere between 2 and 3 trillion in cash. So clearly there is a lot of money on the sidelines. So other sentiment, some of you may have heard of this guy, Dave Portnoy, Barstools. He's really become a day trader, and he has over 1 million followers. I actually heard an interview with him on CNBC Fast Money late yesterday afternoon. So essentially, he's switched to day trading. He's got all these followers. A lot of his followers mimic what he does and says. He's got quite a cult following, and he basically calls out old Wall Street. Some of you may know in the graph down here, he said Warren Buffett may have been a great trader in his day, but he's washed up. And he's saying that because he said, ironically, yesterday that the day that Warren Buffett announced he was selling all the airlines that he was buying, and he's made a lot of money in it. He says he's up 400%. But he also said yesterday, hey, I'm not doing this when I can get back to my regular 9 to 5. I'm just having a good time now. So clearly he knows that he timed it perfectly at the bottom, and it's quite a thing with all the million people following him. So other news quickly, given speculative interest in Hertz stock, they were allowed by the bankruptcy court to move forward with a $500 million secondary offering. By the way, Portnoy at Barstools was asked about this yesterday, and he said that he wouldn't touch it. He would not advise anybody to. But this is a fool's game where the bankruptcy trustees allowing this, because anybody that would buy stock in a company that's in bankruptcy probably is going to lose all of that money, if not most all of it. But we'll see what happens. Carl Icahn was a big shareholder and sold out at about 72 cents. The stock has been as high as $5 or so in the last 2 weeks before the sell-off last Thursday of almost 1,900 points in the Dow. Anyway, so we'll see what happens there. Let's look at market recaps now, because this is interesting. We were on a great 2-week run going into last week, our third week, and then all of a sudden on Thursday we had an almost 1,900 point drop in the Dow, so between 5 and 6%, fourth worst day in history. That was quite a wake-up call for a lot of folks. Sell-off pushed the S&P 500 back into negative territory for the year. The S&P was down about 5.5% to almost 6% last week. So year-to-date down 5%, which isn't a big deal to most folks. In perspective, depending on where you were investing when it started and where you are today. The NASDAQ, led by tech and big tech, up 12%. Again, the NASDAQ 100 index consists of over 40%. It's the 5 big mega tech stocks that we have talked about. Russell 2000 still down 15%. Usually they lead on the way down in a bear market, and they generally need to lead on the way up in a bull market, not a bear market rally. Barclays Ag for bonds is up just short of 3% year to date, which again, that makes sense. Rates have fallen to almost zero range bound. Okay. Looking outside the U.S., the EFI, Europe, Australia, Far East Index for developed markets sold off 5% last week. EM was down, emerging markets down just short of 4%. You can see year to date, there's carnage there. And again, these indexes, especially EFI, is very, very low tech weighting, down 14% year to date. Again, they've had 2 good years in the last 11, whereas we've probably in the U.S. had 2 bad years in the last 11, counting this one among it. Emerging markets down 13%. Global aggregate bond index up just under 3%. So one of our favorite charts we always use from JP Morgan, courtesy of them and with permission, is looking at what's happening year to date, quarter to date, and then since the market peak and the market lows. So it's really no big story. Everybody kind of knows this. Year to date value led by banks and energy still down 15%. Large growth led by big tech and some biotech pharma up 6%. If you go at the quarter, growth is leading at 24% up. The quarter we're in beginning April 1st. Value has rebounded. It was really ugly, down 30 before this quarter. Now up 16% for the quarter. And you see it's pervasive. Value is rallying, but not as much as growth, both in the quarter and in the year to date. Growth looks a lot better. And you look since the market peak in October 2007, before the financial crisis, you can see it's almost embarrassing. Value's up 80% since then, growth up 258%. It's the same story, not as great a magnitude for mid caps and small caps. And if you look since the market lows of March 2009, it's basically a 2-to-1 advantage of large cap growth over large value almost. Not so much a big advantage, but still significant in mid caps and in small caps. Obviously, this is a long growth rally, just like the 90s, until valuations got stretched. But we'll see what happens. If we look at sector, this is a couple of interesting things to point out. We looked at this last week. You may remember last week, if you were on the call, quarter to date energy was up 59%, but it sold off big last week, with especially led by the Thursday rout. Up only 36% quarter to date. Same for financials, up 16% quarter to date. Still, both of these sectors, which are in the value space, down huge. Energy down 32% year to date. Financials down 21%. If you look across the board now, obviously consumer discretionary up 30% year to date, and technology up 25% quarter to date. But technology year to date is up just under 10%. So obviously that's the biggest sector that's doing the best. Still, there's positive advancement in the quarter across every sector, but there are very few winners year to date, led by technology, consumer discretionary. We had this in here. We just like to check PE ratios. Again, I'm not as concerned by this data. You see what's graphed here, one standard deviation from the 25-year average of the S&P 500 at 16 times earnings. We're way past one standard deviation to the north. We're at just under 22 times. And for forward PE, next 12 months earnings. If you take out, though, as we've said repeatedly, the 5 big mega tech stocks, they're trading at 30 times earnings. The rest of the S&P 500 is already trading at around 16 times earnings. It's really not as bad. But as we pointed out last week, for there to be a sustained bull market rally, you have to have breadth. The other 495 names, or the other 3/4 of the S&P 500 that are in bearish territory with negative returns year to date, need to pull their weight. Similar slide we've had, David Rosenberg, we follow daily in his missives by subscription, as he still thinks there's a level of hubris that's as amusing as it is disconcerting. And he charted, again, some of these followers of the Barstool's guy Portnoy, who took their stimulus checks, they opened Robinhood accounts, and they're investing in all these deep, high beta stocks and hospitality industries like airlines and hotels and so forth, and maybe cruise lines, trying to catch them at the bottom and ride it high and then sell them. So we're not out of the woods. The Beige Book says outlook's uncertain. Over half of the S&P 500 companies reporting have taken away any guidance for the rest of the year, and probably will so for next year. But on a positive note, Jamie Dimon says we think we're going to head for a fairly rapid recovery. We'll see. We had this slide again last week. So Goldman still at the same opinion that the market's range bound. We're not going to see anything greater than about a target of 3,000 on the S&P 500 by the year end. So they believe if it holds that most of the gains have been made. We'll see what happens, but you can see here at the very bottom, the risk to the bullish forecast is we don't have a vaccine yet. That's obviously manically being worked on all over the world, and especially in the U.S. Slow rehiring process by U.S. companies. You got an election coming up, and there's also the China-U.S. trade disruption potentially, and the supply chain coming back to North America, especially for pharmaceuticals. So according to Rosenberg, and again, we like to look at, this guy's a pretty smart guy. He's followed by over 1 million subscribers daily, is the savings rate went up 33%. So there is dry powder for new spending. And the bullet that we like the most in this is really when you look at what the government's done, essentially handed out the equivalent of 6 months worth of retail sales in the month of April, which was ready to be deployed in May. That might explain somewhat why things looked really good in May as the economy opened up. But anyway, together with the Fed, this is still the mother of all bailout nations, more than ever in history. And we'll see how much more liquidity they have to inject to make things hold. We've had this in here, we're still not changing. Looking at a price point to get in with some of our clients, it's been tricky. We say, look, we think that there's over sold sectors. You know, people priced energy for a negative price per barrel in April because no one was driving as a demand problem, and which led to a supply glut. So the price went through the floor, but now energy's back and trading in the 35 to 40 range, Brent and West Texas Intermediate. So we think if you look in certain sectors, you just got to focus on high quality companies with good balance sheets. And energy in particular, some of those companies are cutting capex. They're announced layoffs of 10,000 employees. That was British Petroleum. And the next thing coming, shoe to drop, is probably a dividend cut. Oil Dutch Shell already did cut theirs, and their chairman said, we're not going to borrow money to pay the dividend. Makes sense. Consumer staples, things you can't live without, is a great place to be. Also technology, especially technology for the do-at-home economy, the work-at-home economy. Bonds don't really offer much here. Yields are at historical lows. We could test negative rates if things get really bad and the economy shuts down again because of coronavirus spikes and hotspots in various states, which is probably the big concern going on. We do think there are, even in active managers and international markets, there are opportunities because that place has been the worst place to invest, the worst place to go fishing. There are some attractive investments there. And then if you looked at other non-correlated sleeves, hedged equity, distressed debt, private equity involved in both of those spaces, and in gold miners, you know, it's a funny thing that David Rosenberg likes to mention is that, you know, nobody on Wall Street's talking about where the best money's been made this year, and it's basically long treasuries are up 24%. It's a little late to get in that game now because it's probably played out for the most part, unless we dip into a deeper recession. Active managers really earn their keep when you're in a volatile environment and you need good stock picking. This is something to focus on. And then the other thing is it takes guts, but emerging markets have not been this low in almost 40 years as far as their PE ratio. And that's generally where you make your most money in an oversold asset class. So with that, that's our comments for the week. 21 slides or less. If you have any questions, if you would just feel free to email them to info@wealthqb.com. We look forward to taking any calls by clients on the call who have questions about their portfolio, and certainly we're happy to enter into any conversations with your friends and so forth who are not happy where they are. Thanks and have a great Tuesday.